Hi, it's Jared Rogers here from Beyond Accountancy, and it's tax time for 2025. I thought I'd go through with you guys today some of the main things that are changing in the tax system, and just a reminder mostly about how the rules are working for this year. So I thought I'd do a quick review of the ATO's focus areas for 2025, talk about when your tax return is due, what to do if you've got late tax returns, and improving your tax position for the coming year. So the ATO has done an article on their website about what they're focusing on for 2025, and I'll put that on the screen here. So they go through some examples of some ridiculous deductions and what you shouldn't be claiming. If you're interested in reading this article and seeing what they were, you go to the ATO's website. Each article has a unique code. They call it quick code, and this one is 104604. But I'll skip over that. Their main things are work-related expenses, work from home deductions, and having multiple income sources. So they talk about how you need to have proof of your deductions. They can't be private expenses. They need to be substantiated, all that sort of stuff. They talk about home office and they talk about side hustle type income. So let me just summarize that for you. So work-related expenses is our first one. And I thought a good way to summarize a topic is an acronym. I thought, what better acronym for tax than scam, given the entire system is a scam? So there are 4 things to think about. Can I claim a deduction? So 1 is substantiation. You need proof of the expense and to keep it for 5 years. Now there are some exceptions for that. For example, there are record keeping exceptions. If your total claim for work expenses is under $300, you don't need receipts, but you may still be asked to show how you calculated the claim. That doesn't mean you can claim $300 as a random amount on top of everything else with receipts. It also doesn't mean that you can claim $300 even if you spent absolutely nothing for work for that year. You can claim laundry expenses up to $150 based on an estimate, and they explain how you can do that. If you've got small expenses or hard to find expenses, you can make your own evidence. So you're supposed to write that down, and where, for example, the shop doesn't give you a receipt, or the old days when you put coins in parking meters, I know that doesn't exist anymore, but that's an example that they use, or there's just no possibility of a receipt, you can make your own evidence. But it needs to be $10 or less, so that's really a quite useless exception. A common way where people claim expenses and don't need receipts is to claim their kilometers, because that can be done on an 88 cents per kilometer basis. And that's a really easy one to claim. You just need to work out a reasonable estimate of the kilometers. You don't even need a logbook. Moving on to the next letter in our acronym, connection. The expense must be connected with your income. If you incur the expense in doing your job, it's a deduction. If it's not necessarily incurred in doing your job, it's non-deductible. That's pretty straightforward. A is for apportionment. Some expenses are part work and part private. So for example, your mobile phone, you might use it to make work calls, or you might use data for work apps, but you don't use it exclusively for work. It might be 1/4 for work, half work, etc. So make sure if it's part work, you claim a part deduction. And some things are 100% private, like childcare expenses, traveling to and from work, and most work clothes. So if you buy clothes to meet a work dress code, like ordinary business attire, you should not be claiming a deduction for that. If you've got high vis, protective clothes, a compulsory uniform rather than a dress code, then yes, but that doesn't apply to most of us. And finally, M is for my expense. You have to have incurred the cost and not been reimbursed. So if your employer or anybody else has reimbursed you, you can't claim the expense. If the item was gifted to you, you can't claim the deduction. If you salary package that, because you might work for a not-for-profit that allows salary packaging, and you bought that item through your salary packaging deductions, that's not claimable either. The main example of that is if you salary package a car, you can't double dip and also claim the kilometers on your tax return. As always with tax, it's not as simple as might seem on the surface, there are always exceptions to the rule, and there are always special rules. So there are some things that you can claim, even though it's not linked to your income. And the main ones are donations, our fees, superannuation contributions done as a lump sum, and income protection that's in your name, not in super. And there are some things that you can't claim, even though it is linked to your job. And the main one would be entertainment, including business coffees and lunches. So the ATO defines entertainment as being non-deductible, and that means food, drink, and recreation. And you think surely they'd make an exception for business lunches and coffees, especially if you're a salesman, and that's something you do every day. But no, they actually specifically say these are entertainment, business lunches, social functions. The next focus area is working from home. So the ATO has a page on their website. Again, you can search that quick code for a detailed rundown of home office expenses. There are two ways to claim, but those two methods only apply to that list of 5 expenses. So you can see here, you choose one of these approaches and you claim all of these things regardless. So mobile phone, internet, utilities, stationery, computer consumables like ink and paper, you can just keep a diary of your work from home hours and claim 70 cents an hour, and that's all you need to do. And just keep one bill for each expense type, or keep all the receipts for all those categories, add up the total and claim a percentage. For example, your internet connection is never going to be purely for work use, so it'll always be a private apportionment. One important thing to note is that from March 2023, you can't estimate your hours or keep a 30-day logbook to represent your typical pattern of work use. You must keep a diary showing all the days. And that's the more onerous record keeping that they've added in recent times. And the last point is that the ATO is constantly going on about including all sources of income. The government believes it's entitled to a share of everything you've got, and side hustles are no exception. So what they call the gig economy. So if you're doing ride share, deliveries, or other apps where you're paid, you need to include all of those. And those are the kind of bits of side income that they're focusing on. Don't forget to include your bank interest, although that's going to pre-fill in your tax return. Maybe not now in July at the time of recording, but if you're doing your tax August or later in the year, by then most banks would have reported your income for you. But don't forget that if you're an early lodger. Income from shares and ETFs, of course, crypto gains and losses, and short stay rent. So you might be renting out part of your home as a short stay. You might be a renter and have a spare room and then sub rent that room on Airbnb or some similar site. You need to make sure that you're declaring that income because the ATO considers that to be assessable. By contrast, there are some things that where you're receiving money that aren't income and you should be leaving them out of your return. So gifts from a relative are not taxable. Income from hobbies. So what's a hobby? What's a business? Well, it's a very grey area. But if you're a musician, for example, that's something you should be sort of reevaluating every year, whether what you're doing is repetitive or serious enough to be considered a hobby. And there's ATO guidelines for that. Sorry, to be a business, and there's ATO guidelines for that. If it's a hobby, it's not taxable, and you're wasting money by paying tax on a hobby. If it is a business, something you're doing regularly and on a more serious basis, you would include it as business income, but don't forget to claim things like traveling to gigs, the cost of buying and maintaining instruments, things like that. And inheritance is also not taxable in Australia at the moment. And income from board being different for rent. If someone's boarding with you, usually it's a relative or a friend, they might just be chipping in for bills, but they're not paying you an amount of rent that you could regard as commercial. So $50 a week to cover the bills doesn't amount to what you'd be charging a third party for rent, and that doesn't need to be included in your tax return. Again, rent versus board could be a grey area. It's a matter of degree, it's a matter of what they're paying for and how much, but you need to consider what's taxable and what's not, and not be paying tax on things that actually aren't taxable. So our second topic is when is my tax return due? So you can see this by logging into ATO online services through MyGov. But generally speaking, tax returns lodged through an accountant on the 15th of May 2026. If you did your own tax return last year and you plan to use an accountant this year, your deadline will be showing as the 31st of October, and you need to appoint your accountant before the 31st of October, or else that deadline will still apply. If you owe more than $20,000 last year, you have to lodge slightly earlier, and that's $20,000 not counting any quarterly tax installments you paid. So if that's when you have to lodge and then you owe tax, when do you have to pay the tax? Well, for the common deadline, 15th of May, which applies to most of you, it depends on when you lodge. So the date of lodgement dictates the date of payment. So it's quite common for my clients who have large tax bills to either lodge their returns later, or they might sign their return now, but ask us to schedule lodgement for a later time. So the latest date you can possibly pay tax for 2025 is the 5th of June 2026, more than 11 months after the financial year ends. If you want that due date to apply to you, just make sure you lodge your tax return on or after the 13th of March 2026. By contrast, if you've got one of the special lodgement dates, which are 31 October and the 31st of March, the date you need to pay your tax is just 3 weeks or 21 days after the lodgement deadline. If you have multiple tax returns, so you've got some late ones and this year's, then you need to lodge by the 31st of October. Best way to catch up is to lodge all the late years at once, but not necessarily all of them at once. So you can lodge 2025 on its own. The reason we lodge all the late returns at once is because when you lodge late, you generally get a warning first and a penalty next time. So if we lodge all the late ones together, you'll get the warning, not the penalty, which is obviously better, given the penalties can be $1,500 now. It can be beneficial if you're nearly at the end of your help debt to lodge 2025 first and let that be the year that clears your help debt, so that when you're doing the late ones, there's less of a risk that you're going to be late and owing tax. The ATO, surprisingly, don't care if you're late on tax and getting a refund. They care if you're late on tax and you owe tax. So by organizing the lodgements in a certain order, you can make sure that if you are going to owe tax, it's the on-time lodgement where that happens. So they can't charge interest, they can't charge late fines. If you catch up all your overdue lodgements, except for 2025, before the 31st of October, you can get yourself more time to do the 2025 return. The due date should move from the 31st of October to the 15th of May. This is especially helpful if you expect to owe tax. So you don't want to lodge too late, but you also don't want to lodge too early. So if you have ETFs and listed trusts, you need to wait till August for those tax statements to be released. Likewise with wrap accounts, we've got multiple investments under one umbrella. That's more likely to be September, even October, when the annual tax statement is released. Employee shares or RSUs, it can be as late as August and September before you've got your ESS payment summary. And if you've got income protection insurance, there'll be a letter confirming the deductible portion of your premiums, and it's often not ready till late July, early August. And just to wrap up today, when we do a tax return, for the most part, we're recording what's already happened, and our job's to help you record it in the most advantageous way so that we're not missing out on any of the relevant deductions. But there's not much you can do about what has already happened. A tax return is about recording things that have already happened in the previous financial year. The most benefit you get from tax advice is to plan for the coming year. So how could we do that for 2026? Well, I've got a few ideas here. Salary sacrifice, super co-contribution, first home super saver scheme, private hospital cover, and the big 60. So what happens when you turn 60 and why is that an important milestone in the tax and super system? That's all for this video. I decided that in the interest of keeping the videos to around the 15-minute mark, I might separate the planning for next year section of the video from the tax time 2025 section of the video. So I'll wrap this up here. If you're interested in seeing those tips for the 2026 financial year, please go to our channel and click on the next video. Thanks. For our clients, if you're looking to book, just go to beyondaccountancy.com.au/bookings, and all the times will show up on the calendar, whether that's with me or one of the other accountants here. Look forward to seeing you guys this tax time or possibly even next year for those who are lodging a bit later, and I'll see you again soon. Bye for now.